When a war breaks out, the stock market panics almost immediately. Prices drop, headlines scream, and investors start making emotional decisions fast. But here is the fascinating part that most people never talk about. Your money does not just vanish into thin air when markets crash. It moves somewhere else entirely, and understanding where it goes can change how you think about money forever. Let us start with something that surprises almost everyone at first. During a war-driven crash, billions of dollars shift out of stocks quickly. Investors pull their money from companies they no longer trust. Those funds have to land somewhere, and they almost always follow a very predictable pattern that has repeated itself across history. The first place money runs to is gold. Gold has been a safe haven for thousands of years across many civilizations. When uncertainty rises, people instinctively reach for something physical and real. Gold cannot go bankrupt, it cannot be printed endlessly, and no government can simply erase its value overnight. During the Gulf War in 1990, gold prices jumped sharply within just a few weeks. The same thing happened when Russia invaded Ukraine in early 2022. Gold demand spiked almost overnight because fear drove investors towards something ancient and trusted. But gold is just the beginning of this fascinating money movement story. The second major destination is government bonds, specifically U.S. Treasury bonds. Think of bonds as a loan you give to the government with a promise of getting paid back. During wars and crashes, investors flood into treasuries because they are considered the safest asset in the entire world. The United States has never defaulted on its debt in modern financial history. So when everything else feels unstable, people park their cash in treasuries and accept lower returns just for the peace of mind. This creates something economists call a flight to safety, and it is one of the most powerful forces in global finance. Trillions of dollars can move in a matter of days. Countries, pension funds, hedge funds, and ordinary people all make the same decision at roughly the same time. They want safety more than they want profit during these scary and unpredictable moments. Now here is where it gets really interesting and a little counterintuitive. Not all stocks fall during a war-driven crash. Some industries actually explode with growth while everything else is burning down around them. Defense companies are the most obvious example of this pattern. Companies that make weapons, military aircraft, radar systems, and ammunition see their stock prices rise sharply when wars begin. Lockheed Martin, Raytheon, and Northrop Grumman all saw significant stock gains when the Ukraine conflict escalated in 2022. War is terrible for humanity, but defense spending goes through the roof almost immediately. Energy companies are another sector that often benefits in complicated ways. Wars frequently disrupt oil and gas supply chains across major producing regions. When supply drops but demand stays the same, prices go up quickly. This means oil companies can earn extraordinary profits during wartime. Russia and Ukraine together supply a massive portion of Europe's energy needs. When that conflict started, energy stocks surged while tech stocks and consumer companies took painful losses instead. Subscribe to this channel because we cover exactly this kind of knowledge that most financial media completely ignores for you. There is so much more to understand about how money actually moves in the real world beyond simple headlines. Now let us talk about currencies, because this part of the story often gets overlooked entirely. When wars happen, the currencies of affected countries usually collapse in value almost immediately. The Russian ruble lost nearly half its value in just a few days after major sanctions were applied in 2022. People inside those countries see their savings effectively cut in half overnight without doing anything wrong. Meanwhile, the US dollar typically strengthens during global crises because it is the world's reserve currency that everyone trusts. The Swiss franc is another currency that acts as a safe haven during turbulent times. Switzerland has stayed neutral in conflicts for centuries and has strong banking secrecy laws. Investors trust it as a stable store of value when everything else feels chaotic and dangerous. The Japanese yen also behaves similarly during global market stress for different but related historical reasons. Real estate tells a more complicated and regionally specific story during wartime market crashes. In countries directly affected by war, property values can collapse dramatically overnight. Buildings get destroyed, populations flee, and the entire concept of property ownership becomes uncertain and unstable. But in distant, stable countries, the opposite can sometimes happen surprisingly. Foreign investors pull money out of risky markets and buy property in safe countries instead. This partly explains why cities like London, Dubai, and New York often see foreign real estate purchases spike during international conflicts elsewhere. Commodities beyond gold also move in interesting ways during these periods. Wheat, corn, and agricultural goods often spike in price dramatically. Ukraine is called the breadbasket of Europe for good reason, producing enormous amounts of grain every single year. When that supply chain gets disrupted by conflict, food prices rise everywhere around the globe. People who invest in agricultural commodities or farmland can see significant gains, while ordinary people pay more for basic groceries at the store every week. Here is a deeper layer of this story that very few people ever consider carefully. War does not just move money between asset classes, it also creates massive government spending programs that reshape entire economies for decades. The United States spent trillions of dollars during the wars in Iraq and Afghanistan over many years. That money went into military contracts, logistics companies, private security firms, and reconstruction projects. Entire industries grew up around the machinery of modern warfare in complex ways. Government borrowing increases dramatically during wartime to fund all this spending. Countries sell more bonds to raise money, which increases national debt significantly. This can eventually lead to higher taxes or inflation after the conflict ends and things slowly normalize. History shows that wars often leave countries with significantly more debt than when they started the conflict. That debt burden can slow economic growth for an entire generation of citizens afterward. Inflation is actually one of the biggest hidden effects of war on everyday people. When governments print money or borrow heavily to fund military operations, more money chases the same amount of goods. Prices rise across the board and purchasing power falls for ordinary working people. During World War II, the United States experienced significant inflation as the government ramped up spending to unprecedented levels. The same inflationary pressures appeared during Vietnam, the Gulf War, and more recently after COVID-era spending combined with the Ukraine conflict simultaneously. Technology and innovation often receive strange boosts from wartime conditions as well. The internet itself began as a military project called ARPANET, funded by the U.S. Defense Department decades ago. GPS navigation was originally developed exclusively for military purposes and targeting. Radar, microwave ovens, duct tape, and even the humble Jeep all came from wartime necessity and invention. Defense budgets fund enormous amounts of research and development that eventually flows into civilian technology and products. This means that some of the money spent on war eventually comes back into the civilian economy through new technologies and industries. It is a deeply uncomfortable trade-off that historians and economists still debate endlessly. The innovation benefit does not justify war morally, but it does explain why defense spending has such long-lasting economic ripple effects that touch everyone. Watch this video to the end because the final piece of this puzzle is the most important lesson of all for your financial future. Understanding where money flows is the foundation of smart investing over the long term. Retail investors, meaning ordinary people with regular brokerage accounts, usually make the worst possible decisions during war-driven crashes, unfortunately. They sell at the bottom when fear is highest and buy back in when prices have already recovered and risen again. This pattern of panic selling and delayed buying destroys wealth reliably and consistently for millions of people every single time a crisis hits financial markets. The people who build real wealth over time do something completely different and often counterintuitive. They understand that market crashes, even terrifying war-driven ones, are temporary by nature. Every single major market crash in modern history has eventually recovered and reached new highs over time. World War II, the Korean War, Vietnam, the Gulf War, 9/11, and every other crisis eventually passed and markets moved higher afterward. The smart money looks at crashes as buying opportunities rather than disasters to be escaped at all costs. When prices fall sharply, you are essentially getting the same assets at a significant discount compared to just months before. Warren Buffett famously said to be fearful when others are greedy and greedy only when others are fearful. This simple idea captures exactly how serious long-term investors think about market volatility and crises. The real question is never where does money go during a crash in the short term. The deeper question is where does money end up going over the long arc of history and human progress? The answer to that question has always been the same across centuries of economic history. It flows toward productive assets, toward innovation, toward human ingenuity, and toward the unstoppable long-term growth of civilization itself despite every setback along the way. Wars are devastating and destructive in every measurable human sense. But the financial system is built to survive and eventually recover from them every single time without exception. Understanding this does not make war acceptable or less horrifying. It simply makes you a more informed, more rational, and ultimately more successful participant in the financial world that surrounds all of us every day.